Hey, this is Jerry Fetta, owner, founder, and CEO of the Wealth Dynamics brand. Hey, I'm giving you a Tuesday tip today. Now, if you stay and watch this video all the way through, I have a free download I want to give you, but you need to finish the entire video. So stick with me on this. I've got some great information on if you're going to use the infinite banking concept, what do you need to know about who to work with and who's involved in that process so you get it done correctly the first time. Hey, welcome back, Tuesday Tips with Jerry Fetta. So as you guys know, I'm a really big fan of the Sacred Account. The Sacred Account is a financial tool. It's a form of high early cash value, dividend paying whole life insurance. And what we're gonna use that for is something called the infinite banking concept. So the infinite banking concept is where you have an asset and that asset is gonna be growing and you're able to borrow against that asset while it still grows and become your own bank in your life. You can loan that money to yourself. You can use it to pay off debt. You can pay off consumer debt, large purchases. Instead of using a bank to finance your car, you can do that with your in this case, life insurance policy. You can invest in real estate. You can grow your business. But basically, it puts you in a position where, when you deposit money into someone else's bank, Bank of America, Wells Fargo, Citibank, whoever it might be, you put your deposits in there. You're doing that so you can save money, right? You want to store your value. While your value is being stored, the bank is actually borrowing against your deposits and they pay you minimal interest, put your money at risk. And in recent times, they're even losing your money. If you've watched Silicon Valley Bank, First Republic, Signature, Credit Suisse, there's a number of large banks that have failed in the last month or two. And they're taking your deposits, borrowing against those and investing and loaning them out to other people so they can make profit for their bank. Right, and so the infinite banking concept, in this scenario, you would use life insurance. We call this the sacred account, okay? So you're gonna deposit money into your life insurance policy. It's gonna grow, it's gonna store your value in a better fashion than a bank account would, and then it allows you to be the banker. You can borrow against your deposit, you can loan the money out, you can invest, and you can make profit on that system, right? So that's what the infinite banking concept is. Now, if you're going to be doing this with life insurance, here's a couple things that you need to know. First things first is there's one very specific kind of life insurance that works for this, no others, right? So the kind of life insurance is called whole life insurance, right? There's different varieties of life insurance. There's term insurance, there's the universal life insurance. You don't want those. You want what's called whole life insurance, right? Whole life insurance means that you own it for your whole life. Your premiums stay level. There's no internal rising costs. It's guaranteed against loss. It's going to give you protection. It's going to give you tax benefits. And then that whole life insurance needs to be with what's called a mutually owned company. Mutually owned company means that it's not owned by shareholders that are stock, right? Like it's not a stock company, it's not on the stock market, it's not publicly traded. A mutual company means that the owners of the life insurance policies themselves, so like if you got a life insurance policy with a mutually owned company, you're considered the shareholder, right? The policyholder is the shareholder. And that means that when the company makes excess profit, they share that profit back to you in the form of what's called a dividend, right? And so that's the beauty of this system is when you deposit money into a mutually owned life insurance company with their policy, if you set it up correctly, your money gets a guaranteed great rate of growth, guaranteed interest, just like if you're in a bank account. It's gonna have protection, just like if you're in a bank account. But in addition to that, it's gonna receive profit sharing in the form of a dividend from the insurance companies themselves. And you cannot get this with universal life. You cannot get this with term insurance. You can only get this with a mutually owned whole life insurance company, right? So this is very important. Now, the next thing is the design of the policy, right? So I have a policy. If I go to a life insurance agent and say, hey, I want a life insurance policy. I want it to be whole life with a mutually owned company. Here's what they're probably going to do. They're going to sell you a policy. They're going to maximize the amount of your money that goes towards insurance premiums and costs because that also maximizes their commission, right? You don't want this, right? This is called base premium. You want to have very low base premium. Base premium is the cost of insurance. So if I spent money on insurance, I've reduced my cash, right? So in a whole life policy, you've got two different sides. You've got the insurance itself, then you have what's called cash value. This is the savings component, right? If I design the policy correctly, I minimize my cost of insurance, I maximize my cash value so that when I put in money, I have a maximally available cash value. I've got the most money possible going towards savings. And those savings, that's my deposits. That's what I'm going to borrow against, right? So if my agent designs it differently, which is how 90+% agents are going to design it, where they go maximum base premium, minimal cash value, you're going to have $0 in your cash value for the first 1 to 3 years. You're not going to break even where your cash value exceeds what you've put in for probably 15 to 20 years or more. right? And so it's going to be a very slow process, and you're not going to be able to be the bank. You're not going to be able to borrow against those deposits right away because you'll have to wait and let your policy build and build and build and build and build while you lose progress, right? So you want minimum insurance costs. You want to optimize and maximize the cash value. You want to optimize the internal growth rate on your cash value all at the same time. And most agents don't know how to do this, right? Not only do they not know how to do it, doing it this way as the agent, it reduces their commission by about 300%. So an agent needs to be knowledgeable on how to design this. Very few are, and they need to be willing to take a 300% pay cut. Now let me ask you this, an insurance agent works for an insurance agency. An insurance agency works for an insurer. Do you really think an insurer is incentivized to be teaching their agency owners how to sell a concept that brings in 300% less revenue for the insurer themselves? No. Do you think the agency is going to be incentivized to teach their agents to sell a product that brings in 300% less revenue for their agents? No. Do you think an agent, ground level, one-on-one with the client, given the choice of selling a product where they're going to make 300% more versus 300% less and the client's not going to know the difference either way, do you really think there's incentive for them to sell the product that's going to make them less money? No, right? So you need an agent that is typically independent. They don't have an agency over their head trying to push them to drive revenue into the company. They need to be knowledgeable on the concept, and they need to be willing to take that pay cut. Right? Now let's talk about the illustration itself, right? There's a very specific way the illustration should be designed. So here's the things that I look for. On an infinite banking concept style policy, the first year I want to see that 70 to 90% of my contributions are available in cash value, right? So that's the first thing. I want to see that my policy is breaking even between years 5 and 10 where my cash value exceeds my contributions. So that's the second point. My third point is I want to see that, as my policy does start building, if I look at from year 1 to the very final year, my compounding annual growth rate is between 3 and 5% tax-free, right? So that's a third point. And then I also want to see, when my policy is maximized, it's optimally performing, it's at its best point, I'm making, in dividends still that, 4, 5, 6% range, right? And these are all the things I look at. The other thing I'm going to look at is, I want to look at my loan interest rates. Okay, is my loan interest going to be what's known as direct recognition or non-direct recognition? Now, this is insurance nerd speak for when I take a policy loan, does the company penalize me by reducing my dividend? Because I don't want that, right? I want the company to either make my dividend rate flush with the interest rate for borrowing, or I want them to just leave it alone, right? So that I can make more money and they're not lowering my rate for borrowing. So this is called a non-direct recognition company. They don't recognize policy loans as something that should offset your dividend rate. You still earn just the same as if you hadn't borrowed the money. It's going to be, the same dividends and everything coming in. Okay, there are 1 or 2 direct recognition companies that are okay where they'll actually raise the dividend to meet the interest rate, which is fine by me. I like that too. But I don't want a company that they're going to penalize me. They say, Jerry, you earn a 6% dividend, but if you take a loan out, we're going to cut that down or make it 0. You're just going to pay interest. I don't want that at all. Okay, so I'm going to look at that, direct recognition versus non-direct recognition. And then I also want to find out how user-friendly is the policy loan experience. Okay, can I easily put money in? Can I easily borrow money out? Because I don't want it to be a hassle every time I need to take a loan. I don't want it to be a 4-month process. I don't want to have to wait. I don't want to have, oodles and oodles of paperwork. You're right, I just did say oodles. Deal with it. Yeah, I don't want all the paperwork. I want to just turnkey, easy experience, fast. I've got good service. Now, all of this is just setting the policy up, right? Now, in that process, you need a team that can negotiate with the insurance company and they know how to work with the insurance company. The insurance company's job is to find reasons why you should not have life insurance. That's what underwriting is. When you go through underwriting, they're going to look at background, financial, and medical. These are the 3 areas they're going to study. They're looking for risks. They're looking for reasons why you shouldn't be able to get insurance, why your insurance should cost more than their averages because you're unhealthy or you've got weird financial stuff in your background or you've got, a criminal history or something of that nature. So working with a team that has experience with these underwriters and has good relationships with them so they can come back and work and negotiate on your behalf is a big deal, and most agents don't have that. Okay, it takes a lot of volume, a lot of cases, a lot of insurance policies going through where the underwriters will trust the agency and say, hey, these guys know what they're doing, they're stable, we do a lot of business with them, okay? So that's a big component. And then finally is on the back end, does the company or does the agent you're working with actually use these themselves? Okay, because it's kind of like getting your own bank, right? Like it sounds really cool, but getting your own bank, what if you don't know how to use a bank? Okay, and what if the people that help you set your bank up have also never used the bank? How are you actually going to use the concept, right? So you need an agent or an agency that does this for a living. They do this with their own policy. They know what to do. They can walk you through the steps and actually teach you and train you, right? Now, thank you for tuning in. I told you I had a free gift for you if you stayed all the way through. So if you did, I appreciate that. I've got a free download for you today, right? And this free download is actually going to teach you how you can protect yourself from bank failures. I mentioned, Silicon Valley, Signature, right? First Republic, Credit Suisse, these banks that have been failing. They're failing and depositors are being left high and dry. Meaning if you deposit your money in a bank, they borrowed against your deposit, they paid you little to nothing, and then they put your money at risk and actually lost it so you don't get it back. And you can actually avoid that by using the Sacred account and by using the infinite banking concept. So if you click the link in the description, it's jerryfetta.com/bankfail. I wrote an ebook on exactly how the banking system works now. When you give money to a bank, what are they doing with it? And what's the risk? And then the alternative of using the infinite banking concept instead so that you can see in plain black and white, even with pictures and charts, how you can use this as your own banking system. So click that link, download the ebook. Thank you for watching. Like, share, subscribe. I'll see you next time.